welcome. You're watching Money, Money, Money. I'm Samira Abdi. If you're anything like the majority of retail investors, chances are that the bulk of your savings would be lying in a bank. Well, mine did for a long time. That's an honest admission. But I'm changing that now. There are people who want to invest money, but they're too scared to lose it. Well, I understand your fears, but remember that not all investments are risky. Investing in fixed income instruments, for example, provides you a steady income along with investment diversification as well as safety. And that's exactly what Harsh Roongta of Apnapaisa.com is here to tell us about. Hi Harsh, let me also welcome our other guests. We have with us today Mr. Vikas Naik Navre and also Nikunj Vyas, who want to learn a little bit more about these safe investments. But before I get to your questions, I want to ask Harsh what exactly these fixed income instruments are, or money market schemes as they're called, and what class of investors would they suit?
Moment you speak of safe investments, people think of bank fixed deposits. Now, bank fixed deposits are excellent. It's an excellent instrument. But I think what most people don't realize is there are a number of other safe investments. If you are a high taxpayer, especially, one of the big issues with bank fixed deposits is it takes a chunk out. If you are a high taxpayer, 30% or 31% of your interest is taken out as tax. People think that it is just the TDS that has been deducted is the tax. That is not true. The balance you have to pay on your own. So for those kind of people, these other instruments, I mean, you can talk of tax-free bonds, you can talk of normal corporate bonds that are issued. There are preference shares that are being issued by good companies. Now these are fixed income instruments that you might have. You can also invest in a mutual fund that in turn invests in safe instruments. So I mean, you have what are called the liquid or the ultra short term funds that effectively take money from you and invest it with the banks or bank-like instruments. So they would put it in certificates of deposits of the banks, they would put it in government bonds with very short-term maturity, etc. So they're equally safe. They are investing it in safe instruments and therefore the chance that your money will be lost is close to negligible. Similarly, instead of investing in bonds yourself, which is not very tax efficient, you can invest through the mutual funds. They can invest in government securities, they can invest in corporate bonds, and when you invest through mutual funds, the tax efficiency is higher, which means that you pay less tax. In almost, if you hold it for a year or more, almost your entire return will be tax exempt.
Person investing in property, say real estate, fixed deposit and mutual fund, if you have to rate them from safe to safer, which is the best investment over a period of time and with returns?
So I think two things. Mutual fund is a manner of investment, it's a vehicle of investment. So because you put it in the class of safe, we will talk of say a liquid fund or a income fund or a government fund, okay, a government bond fund, gilt fund as they are called. Those are the class of mutual funds that can be compared with a bank FD. Having said that, I think the three things that are important for any investment, okay, is safety, liquidity and return. In terms of safety, a good bank's FD obviously I think scores the highest on the safety parameters. But a mutual fund which invests in safe instruments, it can invest in slightly less safe instruments as well. That depends on which kind of mutual fund you choose. But if it invests, for example, in government bonds, okay, it's equally safe. Or if it is a liquid fund which invests in certificates of deposits or commercial paper and things like that, again that's equally safe as a bank FD. Property, obviously, in terms of safety, also you cannot compare it with either bank FDs or mutual funds of this category, okay. In liquidity, clearly property does not even come into the reckoning. I mean, it's a very heavy cost that is incurred. So I think maybe in terms of long-term safety, it might not be very bad, okay. But clearly, liquidity-wise, it just does not fall in that same category. In fact, the mutual fund, the gilt funds or the liquid fund, for example, scores extremely high. You don't lose anything at all. Typically, it has no exit clauses. There are no exit penalties. Whatever interest has accrued, you get. And you can take as much as you want. You might have invested 1 crore. You want only 10,000 rupees back. You can get that. Now, in a bank FD, you might have to withdraw the entire amount, or even if you have broken it up, that portion you will have to withdraw. In terms of returns, especially if you are a high taxpayer, clearly the mutual funds outrank the bank FDs as long as you hold it for a year. If you are a high taxpayer, bank FDs make no sense at all.
Also, Harsh, what is the benchmark to which the performance of these instruments can be judged against?
Most of the mutual funds follow the CRISIL benchmarks, and they have different benchmarks depending on the period. So for liquid and ultra short term, they would have a benchmark, I think it's called CRISIL Liquid Fund Index, which is for 90 days. Similarly, for ultra short term, it will be for 180 days. They also have composite indexes, which means that they, in a certain percentage, they mix the short term, medium term and long term. Because what benchmark the mutual fund is selecting, that tells you what it is likely to invest in.
Then if you are going to do SAP, let's say systematic investment plan, then what should be the proportion of debt to equity in a selected mutual fund?
Why do you do a systematic investment plan? Because equities fluctuate and you don't really want to take the risk of fluctuation. Therefore, you invest periodically. When you invest in debt, you can invest lump sums. In fact, one of the good ways to invest in equities, if you have a lump sum, is to put it in a debt mutual fund, right? And then systematically transfer it to equity. So that takes care of the fact that your money is earning something, but you are not carrying equity risk of one single time. If you need the money in, say, just 2-3 years, then maybe little bit of risk you can take, maybe 80-85% in debt. If you a much longer period, 5 years or 6 years or 7 years, then you can reverse that. You can have 65-70% in equity, maybe 30-35% in debt, systematic.
On that note, it's time for us to take a very quick break, but we'll come back in a bit, and on the other side, we'll tell you how your asset allocation into debt should actually change as you grow older. Stay with us. We'll be back in a bit. Welcome back. You're watching Money, 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 and all the talk today is about fixed income instruments or safe investments, as we like to call them. We have with us Harsh Roongta of Apnapaisa.com, and also with us we have Vikas Naik Navre and Nikunj Vyas, who are keen to actually learn about these instruments. But I want to ask you, Harsh, we've discussed the why and how of these instruments, but as a person ages, how should their allocation into these debt instruments or money market schemes or fixed income instruments actually change?
Even if I'm a high risk taker, as I near the end of my earning cycle, I should start moving my money away from riskier investments into less risky investments. In fact, there is that age-old rule, which is 100 minus age. So if you are 30 years old, 70%, 100 minus 30, 70% in equity and 30% in debt. And as you near, the issue is at 60, 40% in equity does appear a little high, unless you are a very aggressive risk taker. That does not mean that after you retire, your equity should be zero.
And this would hold true not just for people who are nearing retirement, but also, I suppose, nearing the completion of the goal that they have in mind. So if I'm young and if I only have a 10-year goal in mind, should I still be tapering off towards debt?
Oh, absolutely. Because now suppose if I'm building for buying a house, okay, or any other goals, say going on a holiday after 10 years, I don't want to take the risk that I arrive at 10 years, I may still be young, but I'm saving for a specific purpose, that when I arrive at the end of 10 years, and at that time, unfortunately, the market is down, I may not meet my goal, although I've done all the right things. So typically you start tapering off.
Just to understand the ROI, the return on my investment, had I invested in fixed deposit in 2011 and say a same amount in the mutual fund, say debt linked mutual fund, how good my returns would have been on mutual fund, it being a better instrument of investment? Can you just
let me ask you a counter question before I answer that. I am assuming that you are in the highest tax bracket, right?
Yes.
I have some data here to answer your question. I think in 2011, if you had that FD with State Bank of India, and which is the bellwether for banks, the best FD rate for a 3-year FD in that year was 8.25%, right? Since you are at the highest tax bracket, effectively you got a yield of 5.7%, reduce 30%, 30.9% from that. If on the other hand, instead of investing in the SBI fixed deposit, and since you trusted the SBI brand, if you had put it in SBI short-term debt fund, right, at the same date, if you had divided your money, the return on that would have been 7.82%. And because the entire return would be tax-free, even post-tax that return is 7.82% because of the indexation. So the difference is you would have earned 5.7% net of tax if you had put it in for that part of the money that you had put it in the bank FD. For that part of the money that you choose to give it to their mutual fund arm to put it back into them, figuratively speaking, the return would have been higher at around 7.82%.
Harsh, what is FMP? I've heard that this is a way of investment. Can you tell us something more about it?
FMP stands for fixed maturity plan, which means they tell you upfront that it is for this period. Instead of investing it in these short-term funds, you could have invested it in what is called a 3-year maturity plan, which on the same day it was guaranteed that at the end of 3 years, whatever be the value, you would have got back. That's called a fixed maturity plan. There will be fixed maturity plans that invest in safe investments, and most FMPs are that. The disadvantage is liquidity. That extra return is coming in lieu of the liquidity hit that you are taking.
And what about monthly income plans? Are they also a viable option?
So I think MIPs, as they are known, and typically most MIPs don't really give a monthly income. It has just become a market jargon for what are called hybrid funds, where so there are what are called conservative MIPs and there are aggressive MIPs. Conservative MIPs typically invest 85 to 90% in safe instruments, about 10 to 15% in equity. The more aggressive ones will invest about 75 to 80% in debt instruments and 20 to 25% in equity.
But these are all popular options that we've spoken about. The one option which has never been popular is liquid ETFs. Why is that? Is that not a good option at all?
The liquid fund ETF really is not giving any benefit. It's not being pushed by anybody because the brokers don't make any money. They don't really charge a commission, because the moment they charge a commission, it will stop being viable. The other issue is if you sell it through the exchange, while purchasing it or while selling it, because there is a settlement delay. So it's so convenient to buy it directly from the mutual fund. There is no real purpose that a liquid ETF serves. ETFs are very useful in certain kinds of mutual fund. In the liquid fund part, it is not really serving a huge purpose.
Alright, on that note, Vikas and Nikunj, we'll have to thank you. I hope this has been helpful for you, and I hope the advice works in your case. Harsh, we have to ask you to stay back a little bit longer, but you guys heard it. There are liquid ETFs, like Harsh just told us, not very popular, but of course we've all heard of gold ETFs, which have been extremely popular. This year has seen the launch of the PSU ETF or the CPSC fund. But there is also an equity ETF. So did you know that equity ETFs are a basket of stocks that reflect the composition of an index like the Nifty or the Sensex? The ETF's trading value is based on the net asset value of the underlying stocks that it represents. Think of it as a mutual fund that you can buy and sell in real time at a price that changes throughout the day. On that note, we have to take a very quick break. We'll be back in a bit on the other side.